At the end of a quarter, it can be worth taking stock and looking what's done well and what hasn't, because you can sometimes pick up some useful trends. Now, Mr. Market's not always right. If you were, it'd be impossible to make money, but he can be smart. So you must always respect the market, even if you don't agree with its views. And the manner in which the second quarter's differed from the first could give us all some food for thought. Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this week's edition of our regular Markets Review, I'm going to look at what we can learn from what the market seems to like and dislike right now. Now, regular viewers will know I like to do this by sector, in the view that a bad stock in a good sector will tend to outperform a good stock in a bad sector. So taking a view on a grouping can therefore help you focus your research on certain areas, swerving others, saving you some time, though in the end, of course, you still need to get the sectors right to help your portfolio perform. Now, the best 5 performing sectors in Q2 were, in order, software and computer services, industrial transportation, forestry and paper, real estate investment and services, and household goods and home construction. Now, the first chart shows their performance in absolute percentage terms. They're all up at least 5% in the second quarter against the FTSE All-Share that fell nearly 3% over the same time frame. Now, the only one of those that ranked in the top 5 in Q1, by the way, was household goods and home construction. I suspect that's a bit of a clue to Q2's performance trends. Domestic comfort. Now, strength in sterling may have hobbled exporters, while the market seems to have drawn encouragement, rightly or wrongly, from the general election result and developed a little bit more confidence in the UK's economic outlook. Now, this may explain the enthusiasm for the house builders who reside within household goods, but also the real estate plays and possibly industrial transportation, although that grouping tends to be quite heavily dominated by the share price of Royal Mail, easily its biggest constituent. Now, the next chart takes a different tack, not showing the best performers in absolute terms, but those ones which showed the most momentum on a relative basis. Every week, our good friends at Shares magazine logged the performance of all 39 sectors which comprise the All-Share and then ranked them top to bottom. This graphic shows which 5 areas rose most rapidly up the ranks, and they are software and computer services, industrial transportation, mobile telecoms, general retailers, and fixed line telecoms. Now, again, a focus on the home front can be seen to a degree here in industrial transport and general retailers, while merger and acquisition chatters lifted Vodafone and thus mobile telecoms. Also note the income element offered by the dividend yields in mobile telecoms, Vodafone again, and industrial transport, Royal Mail again. Okay, so that's the winners. What about the losers? Now, in Q2, the next graphic shows that the worst 5 performers in absolute terms were autos and parts, aerospace and defence, life insurance, pharmaceuticals, and industrial metals. Now, again, sterling's strength may have hurt dollar-centric sectors like autos, aerospace, life insurance, and pharma. Worries over government austerity post-election may not be helping defence either, while industrial metals, well, that's continuing to suffer at the hands of ongoing weakness in raw material prices. Now, in terms of momentum, the areas which lost it most dramatically were actually the same 5 names as the worst performers overall. So where does that leave us? Well, the market seems to be thinking the UK and global economy might be finally getting some traction after 5 or 6 years of very loose monetary policy. That consumers are feeling a bit more confident, income stocks remain a focus, and that merger and acquisition hopes means there are still some pockets of value to be had. But in the end, Q2 wasn't a great quarter, given the FTSE All-Share's 2.8% slide. This final graphic shows the FTSE All-Share's quarterly performances going back to 2010. Now, Q2 of this year was the All-Share's worst 3-month period for 2 years. Now, whether this is merely the seasonal sell in May, go away and come back on St. Ledger Day trend, the result of Greek crisis concerns, or something deeper still, we'll only find out in the fullness of time, but it looks as if we should certainly all remain on our guard. So thank you for watching, and I look forward to seeing you next time.